Hello traders, I'm Luke from Discipline Trader. This video is part of the Trading Basics series, and in this one we're going to be looking at understanding the market price. So this will include how to read the price, how to measure price movements, and what a price spread is. So you may have already seen some price quotes for different markets on the news channels or your broker platform if you already have one. You may have noticed that these prices are usually quoted to a number of decimal places, depending on which market you are looking at. However, it can be difficult to understand what this price actually means. Take the Forex markets for example. If you are looking at the pound dollar and the price is 1.2000, it may not be completely obvious what this price means. To understand the price, you have to know which currency is the base currency in the quote. The price of a Forex pair is always quoted against a single unit of the base currency, and this is always the first currency in the quote. So if we are looking at the pound dollar example again, with a price of 1.2000, we now know that the pound is the base currency, so £1 buys $1.20. If the price moves up, this means that £1 will buy more dollars than it did previously, and if the price moves down, £1 will buy less dollars than it did previously. Understanding the price of other markets such as indices, commodities or shares is easier to grasp as the price is specific to only one product rather than a pair. Take the gold market for example. If the price quoted is 1200, then that's all you need to know. If the price moves up, then gold has gone up in value, and if the price drops, then gold has fallen in value. Let's move on to measuring the movement of price, and this can be trickier than first expected. Typically, we measure price changes in pips, points and ticks. You may have heard other traders say something like, the euro dollar fell 100 pips yesterday, or the FTSE 100 is up 100 points today, or if the Dow ticks down, then I'm out, and wondered what they meant. Pips, points and ticks are simply measures of price movement within a market. However, understanding how much movement is equal to 1 pip, 1 point, or a tick can be confusing. Let's again look at the Forex market, and back to our pound dollar example. The price quote for this market is 1.2000. A 1 pip increase in this market would change the price to 1.2001. A 10 pip increase would change the price to 1.2010, and a 100 pip increase would change the price to 1.2100, and so on. When looking at Forex pairs, a pip increase or decrease is usually shown on the 4th decimal place. There are a few exceptions to this, such as the yen pairs, where a pip change is shown on the 2nd decimal place. To make things a little easier, brokers tend to display the quote in such a way to make the decimal place of interest more prominent than the others. They'll do this by making the decimal place of interest a slightly larger font, for example, so it's obvious to the reader which number is representing the pip change. However, to make things just a little bit more confusing, you will often see price quotes to a 5th decimal place now, as brokers have started quoting prices to a 1/10 of a pip. However, brokers do tend to make this decimal place very small to denote its small significance. Also, you will find that you quickly become familiar with how all the different price quotes work when you start looking at them more frequently, so don't worry. The terms pips and points are used synonymously, with the term pips only really being used within the Forex markets, and the term points used in the majority of the rest really. But you may be thinking, why do I care how many pips or points a market has moved? Well, if you are spread betting, and most new traders will be, you enter positions as a bet per pip or point. So for example, if you are spread betting and you buy the pound dollar at a position size of £1 per pip, then for every pip the price of that market moves up, your position will increase in profit by £1 also. Ticks, however, refer to the smallest price movement a market can make. As I said earlier, brokers have started quoting market prices to the 1/10 of a pip or a point. So a 1 unit change to the digit furthest right of the decimal place would represent a 1 tick move. This term is used less frequently by traders, as a 1 tick movement is usually pretty insignificant. The last thing I want to cover in this video is price spreads. When viewing a market on a trading platform, you'll notice that there is a bid and an ask price, or a sell and a buy price. These prices will be slightly different from each other, with the buy price being slightly higher than the sell price. The price in the middle of these two prices is called the mid price, and it's this price that's often quoted on the news channels or articles that you see. The difference between these two prices is what's known as a price spread. The spread is essentially the commission you pay the broker when you place a trade. Brokers will usually advertise their spread sizes across their different markets on their websites, so you'll have an idea of what you are likely to pay in spread costs depending on which markets you trade before you sign up with a broker. Spreads can also vary throughout the day depending on the market volatility, among other things. News announcements, for example, can send the markets rocketing in one direction and then the other very quickly, and brokers will often widen their spreads in such circumstances, so this is something to be aware of if trading around these news announcements. Let's look at a quick example of how a spread works. Let's go back to our pound-dollar example, and the mid price the broker is quoting is 1.2000. They offer a 2 pip spread on this market, so the sell price is 1.1999 and the buy price is 1.2001. If the price were to move up 5 points, the sell price would become 1.2004 and the buy price would become 1.2006. As you may have noticed, if you were to buy the market at 1.2006 and sell it straight away before the price moves at 1.2004, the only money you would lose is the cost of the spread. So 1.2006 minus 1.2004 leaves the 2 pip spread cost. Now let's say that a high impact news announcement has just been made, like the non-farm payrolls in the US, for example. These kind of news announcements usually greatly increase the market volatility, so the broker will widen the spreads on the affected markets as it becomes difficult for them to keep up with all the trading activity. So the price of the pound-dollar may go to something like 1.1990 to sell and 1.2010 to buy, meaning there is a 20 pip spread on this market now. For a lot of day traders, a 20 pip spread will make it very difficult to enter, but the initial news hype does die down quite quickly and the spreads often quickly return to their normal price, but it's definitely something to be aware of. So that wraps up this video on understanding market price. I hope you found it useful. If you have enjoyed the video, please feel free to drop a like on it. If you have any questions or want me to cover any other topics in future videos, please let me know in the comments below. Also, please subscribe to the channel for more videos like this one. I will be continuing this Trading Basics series to provide new traders with all the knowledge they need to get started. So thank you very much again for watching, and I hope you all have a good trading week.